November 11, 2022. FTX files for Chapter 11 bankruptcy protection in the United States. Just days earlier, customers had attempted to withdraw billions of dollars from the cryptocurrency exchange. According to bankruptcy filings, there was an estimated $8 billion shortfall in customer funds. A company valued at $32 billion months before was now insolvent. More than 1 million customers worldwide were locked out of their accounts. The immediate question was not simply how a crypto exchange failed. It was how customer assets that were supposed to be segregated and protected could be missing. Sam Bankman-Fried had been one of the most visible executives in digital finance. He testified before Congress. He met with regulators. He positioned FTX as a responsible alternative within a volatile industry. But the collapse suggested something deeper than market volatility. To understand the decision that ultimately sent him to prison, we have to start with the illusion of strength. Between 2020 and early 2022, FTX experienced extraordinary growth. The exchange offered spot trading, derivatives, and leveraged products tied to digital assets. Trading volume expanded rapidly during the crypto bull market. Venture capital firms invested billions into the company. According to public reports, multiple funding rounds pushed FTX's valuation to approximately $32 billion. Institutional credibility followed. Major investors participated in equity rounds. The company secured naming rights to a professional sports arena in Miami. Advertising campaigns featured well-known public figures. The platform marketed itself as compliant and risk-aware. Public messaging emphasized customer protection. Bankman-Fried frequently stated that FTX did not use customer assets for proprietary trading. He positioned the company as more conservative than competitors. He called for clearer regulation in interviews and public appearances. At the same time, Alameda Research operated as a separate trading firm. Alameda had been founded by Bankman-Fried before FTX. It functioned as a market maker and proprietary trading operation in crypto markets. While publicly described as independent, it maintained close operational ties to FTX. The structure created potential conflicts. According to later court testimony and DOJ filings, Alameda had access to special borrowing privileges on the FTX platform. Those privileges were not available to ordinary customers. During the 2021 crypto surge, this structure appeared manageable. Digital asset prices rose sharply. Trading volume expanded. FTX generated revenue through fees. Alameda generated trading profits. On paper, the ecosystem looked successful, but early vulnerabilities existed. First, governance concentration. Decision-making authority at FTX was highly centralized. According to testimony presented at trial, a small group of executives controlled key financial systems. Second, risk management gaps. As described in bankruptcy proceedings after the collapse, internal accounting and controls were limited compared to traditional financial institutions of similar scale. Third, asset interdependence. FTX issued its own token, FTT. According to regulatory filings and trial evidence, FTT played a role in collateral arrangements and balance sheet representations. As crypto markets began declining in 2022, pressure increased. Asset prices fell. Several crypto lenders and hedge funds entered bankruptcy. Liquidity tightened across the sector. Risk tolerance declined among investors. In that environment, internal financial decisions carried greater weight. According to SEC and DOJ filings, FTX began transferring substantial sums of customer deposits to Alameda Research. Investigators later alleged that these transfers were used to cover trading losses, repay lenders, and finance venture investments and other expenditures. Those transfers were not publicly disclosed. The decision to allow Alameda to access customer funds created structural fragility. As long as markets stabilized and withdrawals remained moderate, the imbalance could remain hidden. But the structure depended on confidence. In early November 2022, a report published by CoinDesk raised questions about Alameda's balance sheet. It suggested that a significant portion of its assets consisted of FTT tokens. The implication was concentration risk. If Alameda relied heavily on a token closely tied to FTX's own valuation, a decline in that token could weaken both entities simultaneously. Within days, Binance announced its intention to sell its FTT holdings. The market reaction was swift. FTT's price fell sharply. Customers responded with withdrawal requests. According to court documents and bankruptcy filings, billions of dollars were requested in a short period. Liquidity stress intensified quickly. The illusion of strength met real-time market pressure. FTX halted withdrawals. Attempts to secure emergency financing failed. On November 11th, bankruptcy protection was filed. The mechanism prosecutors later described was not complex. It was a transfer of customer money. According to SEC filings and DOJ filings stated in December 2022, FTX allowed Alameda Research to draw on billions of dollars in customer deposits. These funds were not disclosed to customers as loans. They were not presented as investment allocations. Investigators allege that the money was used to cover Alameda's trading losses, repay external lenders, and finance venture investments and real estate purchases. That structure was the core vulnerability. On a cryptocurrency exchange, customer deposits are expected to remain available for withdrawal. When those deposits are redirected, the platform's solvency becomes dependent on the performance of whatever they are invested in. According to court documents showed during the criminal trial, Alameda had accumulated substantial trading losses during 2022 as crypto markets declined. Rather than immediately closing positions or raising capital, prosecutors alleged that Alameda drew further on FTX customer funds. That decision escalated risk. Internally, according to testimony from former executives presented at trial, Alameda was given a special line of credit and was exempted from certain automatic liquidation mechanisms on the FTX platform. Ordinary customers faced margin calls when positions moved against them. Alameda did not. The incentives were distorted. Allowing Alameda continued access to liquidity delayed visible losses. It avoided triggering external alarm. It preserved the appearance of stability, but it increased the size of the exposure. As markets weakened through mid and late 2022, the funding gap widened. According to bankruptcy filings, FTX had insufficient liquid assets to meet customer withdrawal requests by November. The alleged shortfall reached billions of dollars. The next key decision involved public communications. In early November 2022, as withdrawal requests accelerated, Bankman-Fried posted statements on social media asserting that assets were fine and that FTX had sufficient liquidity. According to trial proceedings, prosecutors later argued that those statements were misleading in light of internal knowledge of the shortfall. Market confidence eroded anyway. When Binance announced its intention to sell FTT tokens, the price decline intensified liquidity pressure. Withdrawal requests surged. At that point, the structure could not hold. According to regulatory proceedings, later concluded in bankruptcy court, FTX did not have the assets to meet the wave of redemptions. Customer withdrawals were halted. A rescue acquisition by Binance was briefly explored, then abandoned after due diligence. The collapse was immediate. On November 11th, FTX filed for bankruptcy. A new CEO, John Ray III, was appointed to oversee restructuring. In court filings, Ray described what he characterized as a failure of corporate controls and reliable financial information. The criminal investigation followed quickly. On December 12, 2022, U.S. authorities arrested Sam Bankman-Fried in the Bahamas at the request of the United States. The next day, the U.S. Attorney for the Southern District of New York unsealed an indictment charging him with multiple counts, including wire fraud and conspiracy. The alleged fatal mistake, according to prosecutors, was not simply aggressive risk-taking. It was the use of customer funds without authorization, combined with representations that those funds were secure. During the trial in 2023, former senior executives including Caroline Ellison and Gary Wong testified pursuant to cooperation agreements. They stated that customer funds had been transferred to Alameda and used to repay debts and finance trading. Defense attorneys argued that the collapse resulted from rapid market deterioration and liquidity pressure, not criminal intent. The jury deliberated. In November 2023, Sam Bankman-Fried was found guilty on multiple counts of fraud and conspiracy. In March 2024, he was sentenced to a lengthy federal prison term. The legal conclusion was clear. According to DOJ filings stated in sentencing memoranda, the court found that billions of dollars in customer funds had been misappropriated. The decision to blur the line between exchange and trading firm had become a criminal matter. After the November 2023 guilty verdict, the focus shifted from collapse to accountability. In March 2024, a federal judge in New York sentenced Sam Bankman-Fried to 25 years in prison. The court also ordered forfeiture and restitution measures tied to the billions in losses identified during bankruptcy proceedings. According to DOJ filings stated during sentencing, the judge concluded that the scale of harm and breach of trust justified a substantial term. The numbers were not abstract. Bankruptcy filings estimated that FTX owed billions of dollars to customers. Millions of account holders had their funds frozen. Venture investors saw equity positions written down. Employees lost jobs. The ripple effects spread across lenders, counterparties, and crypto projects that relied on FTX liquidity. The collapse reshaped the crypto industry. Exchanges faced increased scrutiny regarding proof of reserves and custody practices. Regulators accelerated enforcement actions. The Securities and Exchange Commission and the Commodity Futures Trading Commission brought additional cases involving digital asset platforms. Policymakers cited the FTX case in debates over stricter regulatory frameworks. The governance failures became a central lesson. According to testimony presented in court and findings in bankruptcy filings, FTX lacked formal risk committees typical of major financial institutions. Key decisions were made by a small inner circle. Internal record-keeping was described by the new management team as fragmented and unreliable. Concentration of authority amplified risk. When control is centralized, oversight depends on trust rather than process. In stable conditions, growth can mask structural weaknesses. Under stress, those weaknesses surface quickly. Incentives were misaligned. FTX grew rapidly in a competitive environment where scale translated into valuation and influence. The issuance of FTT tokens linked company valuation to market sentiment. Alameda's trading activities were intertwined with FTX liquidity. As long as asset prices rose, the ecosystem appeared self-reinforcing. When markets declined, the interdependence became The alleged decision to allow Alameda access to customer funds did not simply increase exposure. It transformed a liquidity problem into a solvency crisis. Once withdrawals exceeded available liquid assets, confidence collapsed. Regulatory lag also played a role. FTX operated across jurisdictions, with key operations in the Bahamas. U.S. customers were technically served by a separate entity, FTX.US. The cross-border structure complicated oversight. As with many emerging industries, regulations struggled to match innovation speed. The trial clarified legal boundaries. The jury's verdict signaled that misrepresenting the use of customer funds constitutes fraud, regardless of industry novelty. The case reinforced traditional financial principles in a digital context. Customer assets must be segregated. Representations must be accurate. Governance controls must be robust. The broader financial implication extends beyond cryptocurrency. Rapid growth, concentrated decision-making, opaque internal controls, and incentive distortion are recurring themes in white-collar financial failures. Technology can accelerate transactions, but it does not change fiduciary obligations. The FTX collapse did not trigger a global financial crisis. Traditional banks were largely insulated, but within the digital asset sector, it marked a structural reset. Capital retreated. Valuations declined. Regulatory enforcement intensified. The fatal mistake that sent Sam Bankman-Fried to jail was not market volatility. It was the decision to use customer funds in ways that prosecutors proved were undisclosed and unauthorized. Growth masked vulnerability. Confidence delayed scrutiny. When liquidity tightened, the structure could not withstand withdrawal pressure. The case stands as a reminder that innovation does not eliminate accountability. Financial systems, whether traditional or digital, rely on trust supported by controls. When governance is weak and incentives encourage risk concentration, collapse can follow quickly. If you value carefully sourced analysis of financial failures, regulatory enforcement, and systemic risk, consider subscribing the channel for future documentaries.